For those of you who are concerned that taxes in Barbados are too high and we can't bear any more taxes, this chart shows you tax levels across selected Caribbean countries, and it shows tax revenue as a percentage of GDP. So tax revenue collected as a percentage of total output in the economy. Barbados is the third highest, following St. Kitts and Trinidad. So we are indeed at the high level based on this measure, which is tax revenue as a percentage of GDP. So looking first at the value-added tax and some of the things that the IMF found following their investigation. The experience is that we started with few exemptions and few items that were zero rated, and I guess as was predicted, we started to increase the exemptions and the zero rated items. And therefore the VAT base has now been fairly significantly eroded. That causes significant distortions, widespread compliance problems, and delays in payment of VAT refunds. So because there's so many tax filings or tax returns that include zero-rated items or items at a lower rate of VAT, this increases the proportion of refunds that companies may claim. So as opposed to if they were paying full rate of VAT on all their revenue, the level of refunds will be less. So there's no denying that we have significant problems now with refunds, and that the IMF is saying is because there's so many zero-rated items, zero-rated industries, exempt industries and items, etc. In addition, the IMF have observed that the VAT threshold in Barbados is very low compared to other jurisdictions. So about half of the registrants, their turnover is below $300,000 a year, and they account for only 4% of the total VAT collected. The figures in this chart exclude VAT on imports. So this is just all the other VAT reported on the VAT returns. And you can see that the bulk of the tax comes from registrants whose turnover are more than $1 million. So the table shows up to 300,000, then 300,000 to $1 million, then $1 million to 20 million, and over 20 million. So bear that in mind as we get to the recommendations. So these are the recommendations. So in order to increase the size of the tax base, the recommendation is to eliminate much of the zero rating of food and consumer goods. You will see in the next slide, this is what is recommended for the next budget. So the first stage would be to eliminate the zero rating of semi-processed and processed foods and beverage, non-prescription drugs, certain items for household use, computers and peripherals. But having said that, they're also saying that once you increase the base sufficiently, you might then be in a position to reduce the tax rate to say 16%. I guess it doesn't sound like much. I guess they could have well said back to 15%, but it depends on the what is left in the basket of zero-rated goods. If you wanted to eliminate all, you might be able to go back close to the 15. In addition to that, they're saying the reverse tax credit compensates lower income taxpayers for that additional VAT. So because of the increased revenue from increasing the base, you would be able to afford to restore that reverse tax credit to what it was before. Remember, the reverse tax credit had been cut in half. In terms of fairness, one of the other observations was that because of the zero rating, taxpayers of all income levels benefit from that, which is not necessarily the fairest way to do it. So regardless of your level of income, you benefit from that zero rated basket of goods. And generally, they're saying that we should reduce the incidence of zero rating. So apart from that basket of goods, wherever else there's extensive zero rating that is not normal for VAT regimes, where there are entire industries that are exempt, that we should pull them fully into the VAT net. Also eliminate VAT refunds to non-registered exporters and educational institutions. In term, excuse me. So as I mentioned, bring tax sectors into the VAT net. They're suggesting that A, there is no need, and B, it's not the most prudent thing to do to have a reduced VAT rate on tourism supplies. And I actually heard David reading this quotation from the report on the radio this afternoon. What they're saying is that the tourism industry faces challenges that cannot be adequately addressed by a reduced VAT rate, even if the rate went to zero. So there's structural, because of the structural problems in the industry. And they're saying it's better to focus on other factors that affect input prices, in particular import duties and cascading of taxes. And they've also observed that around the Caribbean region we are moving more towards these concessions for the tourism industry, and that the danger is that it's a race to the bottom. So everybody's trying to outdo each other in terms of concessions to the tourism industry till you get to a point where you're hardly collecting any direct tax or indirect tax from tourism.